that if certain comparable companies do not pass that filter, do not meet that filter, it doesn't become comparable. So first thing is appropriateness of filter, whether that filter itself can be applied or not. And second is, if you agree to that, you get into another problem, whether that quantum or the size of the filter or the magnitude of the filter, degree of filter, whether that is appropriate or not. Both are highly debatable issues. Now coming to the first filter of turnover filter, whether that turnover filter is appropriate or not. And in turnover filter there are ITT decisions on both the sides. It's a highly debatable issue. Special bench were constituted on, I think, once but could not go through. But the fact is, today we do not have any clear, view on whether that filter is appropriate or not. The one set of decision which says that filter is inapplicable, and our panel member, Mr. Maya Lashman, Mr. Ajit Jain is the person who persuaded the ITT bench in giving that decision. Of course, now he has changed it. At that time he was in the department. Now he may have changed his view, I don't know.
I have still not changed my views.
No, anyways, it was supposed to be lighter. Correct. So, the another set of decision which arise from that is the Genesis integrating system, which was given by the Bangalore Tribunal, which is based on the report given by consultancy firm Dun and Bradstreet. That consultancy firm, while discussing the Indian software sector, had divided companies into certain categories: mid-sized company, small company, etc. In that, they have used 1 crore to 200 crores band as a filter for software companies. Now, what is the sanctity of 200 crores? You go and ask them. They have not discussed in the judgment the appropriateness of filter. The other side of argument which says that there is no linear relationship of profitability with filter. You cannot establish that the higher the turnover, more the profitability. On the contrary, you will find many companies who are reporting higher profitability with lower turnover. So filter may not be applicable. The Genesis says that size of the company does matter. Now if you clearly look at the law, which says that NB, which says that it should affect the price or the margin. Price is the transactional traditional methods, and margin if it is a profit method, that is TNM. That factor should affect that margin, only then comparability come. In 10b2 also, it cannot be straight away taken as a comparability criteria. But Genesis says that size does matter. If you ask my view, I am using this filter just to avoid disputes. I hope and I urge, don't ask me more, because I also don't know the answer. Not enough research has been done on this area, that what is the relationship of filter with the profitability, and I don't think we have any correct answer on this particular subject. I use it only to reduce the number of disputes, and because it has been decided by one of the.
So, actually, you want to discuss? Yeah, let's discuss each filter, otherwise, everything will get mixed up. So, I divide turnover filter into two. One is lower filter and the second is upper filter. So, I am of the view that lower filter is absolutely necessary. 1 crore filter is absolutely necessary, because the companies which are having less than 1 crore turnover, they are either into the startup phase, or they are into winding up phase, and the margins are highly fluctuating. I have carried out a study and I have I don't have the results right now, but I had carried out a study and the margins were highly fluctuating. And that highly fluctuating margins do not reflect the normal trend. So to avoid a abnormal arm's length margin, it is good that lower filter is applied. And I do not know there are any divergent views on this. Even the department is applying lower filter, and rather now the time has come that the lower filter should be increased from 1 crore to 5 crore, or rather 10 crores, because 1 crore lower filter was adopted by the department many years back, maybe 10 years back, when 1 crore was really something. Now 1 crore turnover is nothing and it should be increased to 5 crore or 10 crores. That is my view on lower turnover filter. Now high turnover filter, I am totally against this. My view is that there should not be any high turnover filter, upper turnover filter in case of service companies. I have my own logic to this. I have done a research and I have presented before the ITAT in the case of Capgemini and Willis, and in the case of Willis the chart has been reproduced by the Honorable ITAT, and I have represented that there is no linear relationship between the margin and the turnover. Now the study of Dun and Bradstreet, that has been done for some particular classification purpose. That does not have any relation with the transfer pricing issue. I have analyzed the NASSCOM data. The NASSCOM data, top 50 companies, the turnover ranges from 25,000 crore to maybe 1,000 crores, and then below 1,000, there are, below 1,000 crore, there are maybe 5,000 companies. You just cannot classify any, you just cannot take a band of 1 to 200, and the ITAT has correctly pointed out that if it is 199, it is comparable. It becomes 201, it is not comparable. So the turnover of the assessee is 199 and you cannot compare it with 201 because it is falling below 200. So that is absolutely illogical to my mind, and I am of the view that, I am still of the view, being on the other side, that upper turnover filter should not be applied.
So here one question.
Yes.
If you are taking that logic that there is no linear relationship and that is why this filter should not be applied.
Yes.
So then why we should apply the export filter? Because I have seen in many cases that linear relationship is not there in case of export also. Like many companies are having very high export, say 80% export, but margins are very low.
Yes.
So then export filter also should not be applied.
No,
IPT filter also should not be applied.
No,
so
let's talk about export filter.
Yeah. Now one more thing.
No. Let's talk about export filter. Why do we apply export filter? What is the purpose behind that? Your tested party is exporting. Your comparable is selling domestic. Can you compare the transaction?
No.
That is the purpose of applying export filter, that you apply export filter to find out those entities which are also exporting.
Right.
So that the transactions become comparable.
Right.
There is no relation with the margin in the case of export.
Right. So you are going by the comparability principles.
Just 1 minute.
No. So you are going by the comparative principle, comparability principle.
Absolutely.
So if you read rule 10b,
Yes.
somewhere it says not only there should be comparability in the transaction, but also between the enterprises entering into the transaction.
Yes.
So the size of the enterprise also does matter.
Is size one of the criteria given there?
So,
turnover one of the criteria given there?
See, there will not be specific wording, but why they uses the word enterprises. So the enterprise also has to be similar in various respects. So obviously, how you will compare the two enterprises are similar.
So the point, I think you are right. The point is that what we are saying, and I agree with what Nimra is saying, is that you cannot use it as a quantitative filter. You may ultimately use that analysis for doing qualitative analysis, but you cannot just reject a company based on the fact that this company has got a higher turnover. That's the point.
Absolutely. So if it is a 25,000 crore company, let us take Infosys, then there will definitely be some functional differences. So just do not reject any company on the basis of turnover, just follow qualitative filters and the company will automatically get rejected. Because let us say a 50 crore company and Infosys has intangible rights, Infosys has brand, there are so many other distinguishable facts, but you just cannot apply that, remove everything about 200 crores.
See, if you practically, again when you talk about transfer pricing, practical aspect is very important, because once you apply quantitative filter and the company goes out, you are not giving that company a second chance to be considered anywhere. So when you are applying quantitative filter, you have to be very confident about the fact that what you are doing is right, and that is why if you are somewhere in between about doing it, do not reject it on a quantitative filter, do it on a qualitative.
Absolutely correct. I fully agree.
One more thing, like this 1 to 200 crores. So is it that, I mean, can't we think of any other, like 5 times or 10 times?
Okay.
So what is your view?
Yeah, very good question. Why 5 times? Why not 6 times? Why 10 times? Why not 9 times? So it is, you are giving a tool to the TPO. He will say, you say 10 times, he will say no 8 times. And he will make that judgment.
Right, but the kind of injustice, for example, a company having a turnover of 197 crores, Dun & Bradstreet says 200 crores. So that is not correct. So instead of
is Dun & Bradstreet law?
No, that is incorrect.
Yes.
That is not correct. But so maybe government can come out with some guidelines as what is to be done. I mean, so
that is perfectly fine. Government can come out.
Guidelines, even if they come, it will actually be rigid. You have to look at practical aspect of it. I am telling you that if you start reading the law, half of it you will not actually be able to implement it for transfer pricing purposes.
But can a 10 crore company be compared to a 10,000 crore company?
Don't compare. What we are saying is that do not use a quantitative filter to remove the company out. Then you find out other reasons why this thing, or provide a sensitive analysis to say that this particular company is not comparable for these reasons.
There will be 10 reasons for rejecting a 10,000 crore companies, but not a quantitative filter.
because there is a High Court decision, I mean tribunal decision affirmed by the High Court, where it was said that huge companies like Infosys, BPO,
that also talks about, you are talking about Agnity. Agnity does not say turnover, it's a giant company and there are 6 criteria given.
Right, one
Yes.
of the criteria they also say is that turnover is also very huge.
It is one of the criteria.
Yes.
You yourself are saying.
Yes.
Yes. So they have listed out at least 6 criteria.
Right, perfect.
Which business is this?
Technically.
AGNIT.
So I just want to add one aspect. I agree with what Ajit said, is that if you look at OECD does give some importance to the sales part, the size part. So it says that it might impact. Whereas if you really look at the UNTP manual, it segregates between tangible property and services. So they believe that for services you should not look at the size of the company. So that is what just the interpretation in terms of the guidance that is there for OECD and the UN transfer. See, for companies that engage in manufacturing, volume or the size does make a difference, because there is scale, economies of scale. But services, you will have to prove it. Rather than using a quantitative, I would say that use a qualitative one. So you get a second opportunity to really look at that company.
And for trading companies, what is your view on this?
Trading company also, see, sometimes it's not necessary that the trading element, because again it depends. Nowadays the point is that the commission based on sales only has stopped, right? It is also on the value added expenses and the cost plus on that. So there are a lot of companies who work on that kind of model, because beyond the point trading, if it really goes up and if you take a percentage of sales, you will end up earning a lot of commission, lot of money, which a manufacturing would normally not provide. So I would say that it is not something, again there is no proof, at least I do not have that analysis to say that whether the size would make a difference on that, but I would feel that use a minimum filter and then probably look at the qualitative analysis for trading company.
I think you must have done some analysis.
So that all the qualitative filters would be really dependent upon the facts of the case. It cannot be really, described, or you will have to look at the facts of your case and the facts of the comparable which you want to reject. Let me put it this way, which you want to reject.
See, one thought that comes to my mind is that if you do an analysis of companies, whether it's service or manufacturing, you will see a lot of similar patterns sometimes it is there. So up to say 500 crores, you will find a similar pattern. Similarly, after 500 to 1000, there will be nothing that would be happening. From 1000 crores, it would change. So you will have to do an analysis depending on, as he is saying, as what is the company about. If that company itself is about 1200 crore company, then you can do analysis accordingly. But that qualitative analysis or quantitative analysis has to use as a sensitivity to say that this is how what we are saying, and that's why the company is comparable or not comparable.
And let me add why I am saying facts of the case. If the tested party's turnover is 50 lakhs, will you apply 1 crore filter? No. I mean, ultimately, it is the facts of the case, facts of the tested party, which have to be considered.
Okay, so if there is no relation, then why in safe harbor rules government has come out with different margins?
Safe harbor rules, if you read safe harbor rules are totally independent and they do not have any consequence on the computation of arms and price.
Just a thought,
Yeah.
when government is thinking, see, for big companies 22% is safe harbor and for small companies 20% is safe harbor. So what's the logic?
That is the cost of avoiding litigation.
No, it's the affordability.
Yes.
Okay friends, so turnover filter you have seen various interpretations.
What are your views? You are silent.
Basically, I will not agree with Ajit Jain. That I am for sure.
No, I have never said that. No, Ajit bhai, I have never said that. I will not agree with your view.
You are one of the panelists.
No, I am a moderator. Okay, I will just give you some food for thought.
You are food, sir.
Not thought.
Yeah, so it's like this, that when does a company grow and when does turnover increase is something which we have to understand. So if we believe that companies with higher turnover have better ability to undertake risk, have better ability to have bench strength in service industry, have more ability to withstand the forces of crisis, like for example in the 2008 global crisis, many a small company suffered a lot, but the big daddies of IT in India were able to still sustain that growth with lower compounded annual growth, but still they were able to sustain. So what does this reflect? Does it reflect some economic behavior whereby size tends to allow companies to differentiate in the marketplace, so better market penetration, have size, so therefore you have better ability to absorb losses, so therefore you can take risk with lower, what you would call lower contracts, per hour contracts or per man-day contracts in service industry. Does size allow you to create your own intangibles over a period of time? And therefore, to put it succinctly and crisply, can you therefore say that all these important business characteristics which would differ from comparable company to comparable company is embedded in size? So that is the next question. So size alone does not matter, but is size reflective of an aggregate of all these economic parameters which differentiate companies in the marketplace is something which one needs to put thought to.
So, but going by the interpretation of law, which you are really, going by the interpretation of the law, income tax act or rule,
Correct.
what is your view on this aspect?
Yeah, so therefore, I have given you my view, no?
No, so that is the logical view you have given, but the interpretation part, sir.
No, I give you my view of law that I believe turnover is not a reflection only of size, but is a culmination of many economic factors, and therefore it can be, if used properly, as a form of differentiating different companies with different comparable features.
The ability to
Attract talent also, no? So for example, today, the larger, what do we find in the marketplace? That the larger companies have the ability to attract better talent, attract better contracts, attract so many things. Why? Customers. Why? That's the question we have to ask. So if we say that turnover simpliciter is not correct, is a fair view. But is turnover simpliciter? And the answer is no. The turnover is a result of various economic factors which get embedded in turnover. So, yeah, including brand, intangibles. So therefore, turnover is a reasonable criteria then for differentiating or not. It's something for which you have to apply your mind.
Which is a qualitative analysis. That's again the point,
Yes.
not a quantitative analysis.
No, But what I am trying to say is that if everything gets embedded and dovetails into size, and then you take size as a filter, is that wrong? If you can differentiate that because of size, these many different qualitative factors are embedded in that size. So I don't believe that the tribunal decisions or the high court decisions or any transfer pricing literature says that there is a linear relationship between margin and size. It says that companies with large size, for example today, Telco is bleeding, Tata Motors bleeds in the last 4 or 5 quarters, but it still sustains. Would another company have sustained? It would have got liquidated by now. Why? Because it had size, so it had reserves, so it still has intangibles, it has group support, it has got so many other things. So therefore, all these matters get embedded in size only, no? A small company can never aspire to be an Infosys, no? It's like that. So therefore, size is not the only criteria, but size is the barometer of all these intangibles embedded in it. That is my perspective.
Sorry, I mean, the point is that there is a possibility that a company which may be smaller in size to Tata Motors may be making larger profit than Tata Motors.
No, but we are not talking of profit.
No, I'm saying that
because of the size, Tata Motor is not making profit.
No, I'm saying that the point only is that
No, we are talking of comparability. That's all. We are only talking of comparability.
So my mind, using a quantitative filter may not be appropriate. It has to be used as a qualitative analysis where you can bring the sensitivity analysis to say that why it is so. But you cannot use a standard.
So it's like the chicken. Correct. So it's like the chicken and egg story.
No, Mr. Bhai, I'll add to this. You are saying that size matters. You know, in different words, you are saying size matters.
No.
So let us.
One minute. Just for a little joke. Friends, did I say that?
Okay, Mr. Bhai, let us. Okay, so just agreeing with you without admitting. Just agreeing with you for a minute.
That is Ajit Bhai and the tribunal.
Yes, just agreeing with Mr. Bhai just for a minute. Size matters. How should we apply quantitative filter?
No, so therefore,
what is the filter that should be applied?
So therefore, you can
there be any subjective or objective criteria for this?
Therefore, quantitative filter, simpliciter cannot be applied, but because size embeds within itself certain economic parameters which differentiate that company from the other company in the marketplace, it can be rejected. So is it only size? No. But is size critical? Yes.
Yes.
Qualitative analysis.
Yes. That is again qualitative.
So yeah, you can put it like that. I agree with you.
Thank you, Mr. Bhai.
No problem. Yeah.
No, that's what I also said in the beginning, that this issue or this turnover filter is a debatable thing, and one can go on debating it. But and the other issue which was raised was that let us say company of 190 crores can be compared and company of 205 crores cannot be compared. I just wanted to nothing on filter as such. I was on the principle that in any kind of slabs, the situation, data points at the edge will always bring distortion. Like that can happen in income tax slab also. Suddenly your income is higher by few rupees or few thousand rupees, and suddenly tax rate is 30%. So this kind of, I just wanted to draw your attention that statistically, data point near the edge or border will always have that element of distortion in it. That's.
I think this is a very good point which Mr. Kote has said. And therefore this brings me to another question. I mean, it's not there in this case study. So actually all this debate which takes place on these filters is because of the rigidity of 92C, mean price, arithmetic mean. The whole problem emanates from that, is that the best measure of an arm's length standard is something which has not yet been debated in law. is the arithmetic mean of comparable uncontrolled transactions the best way to benchmark an arm's length standard? Is something where law will evolve.
But now I think it's going to rain. It may not come, but
Yeah.
maybe next
No.
year. Next year we'll debate that.
No, but I think if one were to see the law, is the range after the mean or it is a range in totality?
In totality, only if you don't have adequate comparables, then you have to use arithmetic.
Arithmetic mean. That is the finance minister's speech.
Doesn't be enacted.
It has not been enacted.
No, I will just read what it says. Provided also that where more than one price is determined by the most appropriate method, the arm's length price in relation to an international transaction or specified domestic transaction undertaken on or after the first day of April 2014 shall be computed in such manner as may be prescribed, and accordingly the first and second proviso shall not apply. So therefore, will they accept completely the range, or how they will do, that is something which we have to see. And whether it is for the full range, whether it's an interquartile range, whether they will accept or not accept, I think these are all debatable.
All debatable. Because as on date, we do not have the
Correct.
rules.
So therefore, that is the main thing. And can you differentiate? I think most important thing will be, I do not know, Mr. Kote, you can throw some light on this, is that can you have different arm's length price methodology for two different assessees by prescribing range in X case, in Y in another case? Is there a classification issue? I do not know.
Now this is applicable for FY 14-15, right? So now, but still it is not out.
Yeah.
So,
Because still trying to file return of income and make self-adjustment.
Yeah, just to extend some general discussion. See, qualitative filters are always better and superior in terms of reliability and what you say. But qualitative filters has a flip side. It is more subjective and it is difficult to apply because all the qualitative information may not be available. So, quantitative filters are easier to apply, but it has its own defects as it has been pointed out. Now, to overcome these defects, one must have necessary study and research which has been done, which could go into all aspects and reduce the subjectivity. But unfortunately, in India, the tendency or attitude of research is very low, despite we have tremendous talent pool. So that's why this turnover filter is creating more and more issues, because we have not studied these issues in depth. Nobody has time to do that. Anyhow, we can move to another filter. Another filter. Now the employee cost filter. Employee cost filter again is a similar sort of quantitative filter. And what matters in my view is the quality of employee which can bring or generate higher revenue or revenue for the software company, and not the number as such. So this filter, to my mind, is totally unscientific and should not be used at all. I have come across only one decision of tribunal which has not approved employee cost filter, but it is altogether on different reason, because that there was no data available with the comparable companies, and TPO had earlier not used this filter. So it has nothing to do with the appropriateness of the filter as such. I have not come across any discussion on appropriateness of this filter in any of the judgments. Of course, NASACOM use employee cost as one of the barometer to differentiate software or ITDS companies, but I am not very sure that certain level of companies or a percentage will have linear relationship with profitability. So that's it.
No, so I agree. I mean, it is very case specific, and you can get a lot of data of the assessee company, but obviously you cannot get the data for the comparable company. So it is not something that is suggested. I would also agree with that. Also, a relevant point is that the databases, when the database providers are actually putting these databases together, they also do some recharacterization and reorganization of the cost sometimes, and so that is why there could be an issue on that. So that's an additional point, that maybe the data itself on a quantitative basis also may not be as reliable.
So I agree with Mr. Kode and Rohan. The only thing is, if this filter is to be applied, presuming that this filter is to be applied, then how should it be applied? Should it be some percentage lower and upper than the tested parties ratio, or should it be some percentage applied, on universal basis? What should be the percentage?
See, if ours is an employee-oriented based company, for example, is consultancy firm, something like that, then we can apply the filter, reject companies having employee cost less than 25%. Because if it is a consultancy firm, employee costs are bound to be at least 25%. So maybe that can be done where employee cost is bound to be very high. And that position has been upheld in a number of tribunal decisions. So I think that is something which can be done.
So some percentage,
Yeah,
not like in this case filter has been applied, like the employee cost is 65% and DPO has applied 50% to 80%. Because that is again subjective.
Correct.
Yes.
And also in some of these cases, and there is this famous company Vishal,
2%,
which basically has an outsourcing model. Where the employee costs are not captured. So again, there are a lot of these dynamics that are there.
I think it's like this, that from a comparability perspective, for example, when the tested party has a ratio of about 1.6 times its employee cost, it has been marked in various economic studies that where human capital is the main capital, that the whole man-hour rate which is derived on a salary multiple. It has been accepted in some US cases also that the salary multiplier is the best way to come to price. So therefore, why is salary multiplier used? Because the human beings that are there, the human capital is nothing else but machines. And if they are machines, then their output, which is man hours, has to be used for the purposes of quoting to clients. And based on the cost that you incur on the man hour, you will quote for various jobs. That's how TCS does, that's how Infosys does. And you have rates of software employees, various categories, various types of companies. So embedded software may have the highest rate. So therefore, depending upon which industry you are benchmarking, I believe this is a critical filter. Because if you ask any consultancy firm, what is the salary multiplier they use? And how do they use that salary multiplier to bid for projects? So for example, when professional firms charge per hour, what is it based on? It's not some figure which comes from heaven. It comes on your own cost and a multiplier. So therefore, actually they say that consultancy firms look at 3:1 ratio. Software companies are in the ratio of 1.5 to 2:1. The branded ones have better. So therefore, investment banking, the ratio will be 1:6 because it's a success-based organization. So this is my perspective, that in which industry, how to apply, you have to apply and you do it after proper analysis.
The next filter is R&D filter, R&D expenses filter. Now, this requires a bit of discussion that there is a difference between R&D and R&D resulting into intellectual properties. Now, world over, it is well known, and all of us know that the real profit earner is the IPs. The real differentiator between two companies is the intellectual properties, whether it is brand, whether it is what you say trademark, whether it is the know-how or technology. The best example anyone can give on this is the, let us say, Apple. You have MP3 player or you have smartphone, but Apple profitability is altogether different. $178 billion cash reserves. So it is not a simple all that Apple has derived profit is because of its IP, and IP is because of R&D. So nobody can deny that R&D has a great, what you say, differentiator as far as comparability is concerned. But there are two aspects to this. That whether that R&D, one, has resulted into IP or not. Number two, whether that IP is commercially successful or not. You will come across number of examples where there are IPs, but they are not commercially successful. Like you will recollect the earlier, era of pagers. A pager was an innovation, and I am sure a lot of expenditure would have gone into it to realize, to result into that commercial application or commercial product. But life of pager was, if I remember correctly, was exactly 1 and 1.5 years. So similarly, I am not very sure that company who would have invested so much would have even got return from that particular thing. You would also recollect one real value. There was a company which made ceasefire, and that was a runaway success. But they introduced another product which was some vacuum
sealer. Vacuum.
Yeah, to keep food fresh, and that product bombed. Whatever they had earned in ceasefire, their entire earnings wiped out. The point I am trying to make is that every R&D expenditure does not result into commercially successful innovation or product. That's what OECD paper on R&D expenses also has said, that R&D expenses outcome, commercial outcome, is highly uncertain. Having said that, now whether you should have filter based on that or not, one of the tribunal decision, that is Delhi Tribunal in Motorola, they have said that the R&D could be of two types. One which could result into the product, and the other is improvement of process. If the R&D is for the improvement of process, then there cannot be any differentiation, and there need not be any differentiation based on that. But if it leads to product, then it could be differentiator. But I go one step further. I believe that if R&D results into commercially successful product, only then it should be differentiator. And the other thing is, other aspect is, of course, the quantitative aspect is the what is the sanctity of that 3%. What is the logic? Why it cannot be 5 or why it cannot be 2? I am not very sure that we will get very clear-cut answers on this. But as far as I am concerned, unless I see that there are IPs and IPs giving profit to the company, I don't, make the company, consider the company incomparable only because it's spending or it is incurring R&D expenditure. That's my view.
See, I think just to take the point that Mr. Cordes said about 3%, because I don't have the analysis on that, but apparently it seems that corporates globally, if you look at on an average, they spend on a normal basis 3% of their amount into R&D. So there is a presumption that anything above 3% would actually result into some kind of intangible. So maybe that is one of the logic for that. And it's not something that why 3%, why not 4%. There is some kind of a basis, but again, it cannot be said that this report is something that can be definitely looked at. There is no law. But I would presume that by putting in this, so depending on who the assessee is, so if you are looking at the assessee to be a non-risk bearing, then obviously any company spending more than 3% would entail that, okay, there is some kind of intangible that is going to be getting created. It may not happen so, but in this case probably it would be relevant, and we ourselves use that filter to say that company spending more than 3% in case of non-risk bearing is a good amount of filter to be used. And I think it goes by what even the standard of comparability laid down by the OECD as well. Not on 3%, but the use of the R&D filter.
I don't have any specific comments on this. The only point is that, yes, again 3% is not sacrosanct, 2 and 5 or 4, whatever. Second, that again it should be a qualitative filter, not quantitative filter in my view.
But then we can compare the R&D expenses to sales of our SSA or the taxpayer with the comparable companies. But one more question will arise when my company, the taxpayer is new to the market. The first 2 to 4 years, they must be incurring more R&D expenses. So how are we going to compare it? How are we going to filter the comparables? But thereafter it is easy to compare. But the starting years will be difficult to compare.
So for that matter, in the starting year, all the expenditure will be on a slightly higher side.
But then how are we going to filter it?
So then you will have to, either you apply exactly same filter, whatever percentage you are incurring. The same filter should be applied if you really want to apply a filter. Or otherwise it should be analyzed on qualitatively basis. Rohan, you have something to add?
No, I think, see again, what we are saying is that this is all we use as a sensitivity analysis kind of situation. R&D probably is one scenario where, as I said, there is a good amount of literature available that 3% is the more or less average figure. So depending on really, so if you're depending on your taxpayer, what are we looking at? If it is a company which is absolutely risk-free, then there will be no expenditure that would be there. If it is a company which is spending a lot of money, then anyway we are saying that we want to look at companies spending more than 3% on the R&D in that sense, because we are then trying to look at companies which are having intangibles or probably are spending R&D in a larger way. So 3% is a kind of thing, again no sacrosanct, but it's again subjective. There will be practical about it.
So when we do comparable analysis, what are we trying to see on the debit side of the P&L account is the intensity of costs, if they are reflective of any comparable behavior or any economic behavior. That is why I've used these figures just to create a debate. That what does the analysis of the P&L account do? It tells us of the intensity of cost, means the tested party, means the entity which is paying tax in India, is to understand the intensity of cost and its relationship with the operating model. So that will give you some insight. So R&D cost, employee cost are insights into the functioning of the entity, which if you want to do comparable analysis, the law says that they should be replicated in comparable companies. And therefore how you use these filters is based on that analysis. The intensity of cost, I believe, even MP expenditure is nothing else but intensity of cost.
Now we can go to the fourth filter. If there are, RPT. Now RPT related party transaction, there is no particular provision in the Income Tax Act, and there is a provision in the Companies Law, but it doesn't again prescribe percentages. Companies Law logic is that disclosure requirement, that if you are having any transaction with related parties, it should be disclosed. So all annual reports disclosed related party transactions. Now as far as the concept is concerned, I am sure all of you get that concept why related party transactions can be used as one of the filters. The logic is that if you have transaction with related parties, there could be presumption of manipulation of party by related party, price manipulation. Now whether actually it happens or not, that is altogether a different thing. But one presumption is drawn, and on that presumption, this filter is applied. Now another aspect is what is the quantum of that filter. Large part of tribunal decisions have taken 15% as a threshold for distinguishing RPT and non-RPT, and many of the decisions have taken 25%. My personal view is that it should 25% has some basis or some logic. That logic comes from two aspects. That in transfer pricing, which particular entity is to be taken as AE, one of the criteria is the capital. And whenever the capital subscription is more than 25%, or 26%, then the that company enterprise is taken as A. The other thing is in 40A2, the substantial interest for applying 40A2 is taken as 20%. So if you take these two laws together, then we can probably arrive at implied quantum at 25%. And again, if you think conceptually, that higher the position of influence, higher the value of transaction, the greater the chances of influence, possibility, not actually. So if you have 15%, it's to a lower threshold for possibility of influencing. One man can argue that one can influence even without having any transaction. So that is different thing. But this is on reality. So I would say that 25% is a fair threshold to apply for RP.
So, in my view, something between 15% to 25% is a good threshold. And Willis in Mumbai ITAT said that depending upon the number of comparables available, it should be something between 15% to 25%. I found that that is a very, very logical decision, and I agree with that.
See, again, just to go back and speak to your point, the law actually has a zero tolerance for RPT, which would mean that even if it is 1% transaction, you cannot use it as a comparable. But having said that, then it becomes very difficult. You can actually start with that, but probably you will end up with hardly any comparables left. And hence then you have to look at a practical aspect of it. So normally what we do is that we use that as one of the filters subsequently, where we look at up to 25% is something, and that is the same logic that 26% is the the associate enterprise definition.
I think the law is clear, it is 0%. But law is evolved to say that if it is impossible to get comparables, then some range is better. So the lower the range, it is better, means less the influence. So if you have a reasonable amount of comparables, then Willis says that even 15% is good enough, or even 10% is good enough. If you don't have enough comparables, then 20% may be required. Then 25% also may be required. So it depends upon case to case. But ultimately what we are trying to zero in on is on reasonable amount of comparability with least related party influence. It's like this. This particular proposition is there only when you apply a profit-based method. In CUP, can you say I will take 2 transactions with associated entities and 10 transactions with non-associated entities? It is 20%. And take average and do CUP? Answer is no. So then why is it that for profit-based method it is correct? That I do not know. That Mr. Kode will answer as the final answer. Okay friends, I would like to thank
any other method is also any other filter is applied, any of the 4 filters.
Like that there are so many common ones. I think these are the most common which I found.
I have one question, sir, that is another regarding filter, regarding consistent loss filter. Sir, I have a question for you, sir. There is a company which is having a losses in 3 years, say 100 crores, 50 crores and 20 crores, but the losses are reducing year by year and its turnover is also increasing. So in that case, whether use of consistent loss filter, rejection of that company because of the filter of consistent loss is correct. Yes, there is a consistent loss, but the losses are reducing year by year, turnover is increasing year by year. So there is substantial improvement in the performance of the company. So that this comparable can be rejected on the ground of consistent loss.
I will answer this question from 2 aspects. One is that from the point of view of OECD guidelines, which says that company making persistent loss will have some situation because companies are not expected to make losses consistently. So that factor needs to be looked into, and if the factor is found to be business reasons, then company should be accepted. But as I said, I will answer in 2 parts. The second part is, I can guarantee you no TPO will accept this company.
No, because in the director's report it is clearly mentioned that losses are because of downturn in the economy, US economy, and because of that the company has incurred a loss.
So Deepak, there are
I'm
factors.
not very sure because see, I'm not which sector you are talking
I
about.
am giving the example of Allfact Technologies Limited.
No.
ITS.
See, ITS we can discuss. See, downturn. In fact, I have come across a lot of literature which says that downturn, in fact, has helped Indian software companies, ITS companies. The reason being, during downturn, companies want to save cost, and for saving cost, the outsourcing is one of the easiest way to do that. And downturn, in fact, has helped many software companies. So I am not very sure downturn itself could be a reason.
I would like to thank the panelists, Ajit, Mr. Kote, Ajit Bhai, Rohan, Naresh, and my friends, most of you all, because you all participated, made it more lively. And hope we meet again and in some other forum, discuss in depth some more things. And thanks a lot.
Thank you.
Thank you, SP. I think it was much more than expected. I think the panelists must have also enjoyed. With this, I think this is more a panel discussion which is going to be followed by a small concluding session which will take not more than 5 minutes. I request our President, Mr. Paras Savla, to just join us just for 5 minutes. Anybody has just one or two quick suggestions on the whole course what we have designed? Because we need to actually improvise year after year, and based on your suggestion we would like to really change it. Anybody has one or two thoughts on the course, please?
One thing which I noticed is that, so because of time constraints, sometimes very important things didn't get discussed in depth. So maybe if the scheduling can be done accordingly,
Okay.
or maybe just pick up that portion and go into it as a full panel
We will try
discussion, that would
to,
be
if we can put certain subjects later on by an email, that these subjects require more time or this thing, we will surely improvise in the next course. Sure.
Yeah, thank you so much.
Anybody else? Yeah.
This way I found that certain topics, certain case laws were repeated. And each speaker said to 5 issues, let us say A and B. The AP was discussed today, AP was discussed yesterday, Pharma, AP was discussed earlier also. And because the speaker had 5-6 topics, and 6 case laws, then no topic could be discussed in depth. So while structuring the transaction, already the organizers know what are the issues, what are the leading case laws. So we may give maybe 2 topics to the speaker, so that those 2 topics or 3 topics can be discussed in 1.5 hours in depth.
No, Tarun, you had attended the advanced part of the course, but in the first 2 sessions it was discussed in great detail, the AMP part.
Repetitive.
I get your point, but we can't edit the presentation of a speaker, we just come one day before, so it's very difficult to edit there.
I agree, but when inviting the speaker, we can say, you focus on these 2 issues.
Surely we'll
Focus on these 2 issues.
do it.
So what you
We will do
the first
we
4
will do the
days,
needful.
you can keep only the basics. So only on the concept part. And the last 2 days, only the issues along with the latest
Case studies
developments.
or something.
Sometimes the cases are being discussed from different perspectives. I mean, even if it's the same case law, the perspective might be quite different. So,
Perfect. I think we'll take on, please give your feedback also. We'll surely improvise it next year. And I now request Naresh Bhai to just thank the audience, the panelists and everybody to make it for the whole program.
Friends,
Naresh Bhai, 1 minute. I would just like to request Paras Bhai to just say something.
Friends, this typical we are doing year after year and we are getting the participations from the event. But at times we feel that this course can be done in much better way also, because there is always scope for a betterment, and which the history is thriving for it year after year has been done for us. He has brought every time some innovations in this course, and regularly we have been doing it. But we require our feedback, the sheets which have been circulated. We want the true feedback so that this can help us for designing it next year. I thank Crispy for designing, taking up care and making up very good sessions, which is more meaningful for participants. It's not only for the who is a junior or who is an entrant to the profession, but even for the person who is a senior to the profession. He also learns something new from this. Of course, the chairman or Naresh Bhai, he has taken the pain and taking all this, because the 24 sessions over weekends, it's a Herculean task for a committee to work on it, and without the efforts of the chairman, being involved in this whole process, it's not easy, because the many activities going